Problem 11.2a asks us to analyze a bunch of transactions having to do with owner's equity, then to journalize those transactions, and then to make some assumptions. They want us to prepare a statement of retained earnings based on these journal entries, and then prepare the shareholder equity section based on the updated statement of retained earnings. So, the first transaction, they purchased 4,000 shares of their own stock. Remember, when you purchase your own stock, it's treasury stock. It loses all other identifiers. It loses the concept of par, and all of that goes away. It's treasury stock, and we bought it for 20 bucks. This is the number that's important, what we paid for it. If we sell it for more than $20, we'll have additional paid-in capital treasury stock. If we sell it for less than $20, we will have to reduce retained earnings or additional paid-in capital. That was January 1st. January 5th, we declared a $2 dividend payable on February 28th. Now let me explain the way a dividend works. The minute a company declares a dividend, it's an immediate creation of a dividends payable and an immediate reduction to retained earnings. And that's what we see here. We see a debit to retained earnings, which makes retained earnings go down, and a credit to dividends payable, a current liability that goes up. It's an immediate reduction to retained earnings. Even if it said we're going to pay it in the year 2030, it's still an immediate creation of a current liability and the immediate reduction of retained earnings. Then on the 28th, we got around to paying that. So that's just simply, basically reversing entry. Notice that we debit the dividend payable that we credited. That goes down. And we've credited cash. That goes down. So our company is now worth $72,000 less than we started. That's the way a dividend works. You're giving back to your shareholders some of the earned income of the company. Now, if the company has no earned income and they're paying back their shareholders out of other assets, that's called a liquidating dividend. Okay, now, here's where we have an issue. On July 6th, we sold 1,500 shares at $24 per share. Okay? So we sold them back at 20 or 24. We bought them at 20. So treasury stock, common shares. You could list common. It's not often that that's done. We have $24 times, I'm sorry. We have 1,500 shares at $20. That's what's going out, because they go out at the same number they come in at. And then we have additional paid-in capital, treasury stock, 6,000. So the cash we got is $24 times 1,500. It's 36,000. 30,000 of it is what we paid for the shares. $20 per share times 1,500. The other $4 per share is additional paid-in capital treasury stock. Now, next time around, things were not quite so good. We sold some more stock, but we didn't sell it for more than 20. We sold it for less than 20. So we sold 2,500 shares at $17 per share. So clearly they had more in treasury than just those 4,000. Or that's the remainder of that 4,000. There's 15, now they sold 25 at 17. So $17 per share, the selling price, minus the remaining 2,500 is 42,500. 2,500 shares at $20 per share is 50,000. We're getting rid of the additional paid-in capital of treasury stock. We used it all up because we sold it for less. So that has to go away. We still don't have enough to cover it, so the remaining 1,500 comes out. So the 50,000 you can compute. The 42.5 you can compute. The 6,000 you can compute. This number is simply a plug number. You add these together, you subtract from this, and whatever that number has to be, it has to be, and that's treasury stock sold at a loss. First you eliminate any additional paid-in capital treasury stock, then you go to retained earnings. Okay. Then on September 5th, this company declares the dividends of $2 per share to the stockholders of record. So we had to figure out how many stockholders there were at record. And we're told that there's 40,000 shareholders. That's in the additional information. So we have 40,000 shares, $2 per share. Now remember, of that 40,000, we had bought 4,000 back for the treasury shares, but they've all been resold, so they're now back out there as common stock. So it's 40,000 shares, $2 per share, $80,000. Debit to retained earnings, the immediate creation of a dividend payable, a current liability. And on the 28th they paid it. It's the same deal. It does show you what happens. The dividend payable goes down. The company's assets go down. The company becomes somewhat smaller. And then they tell us at the end of the year, the company had a $388,000 credit balance in income summary. Let me remind you what that means. When you're closing your accounts at the end of the period, you carry all your expenses over. You debit the expense, or you credit the expense, you debit income summary. So we credit expense A, debit income summary. Credit expense B, debit income summary. Credit expense C, debit income summary. Then we go to the revenue accounts. We debit the revenue account, credit income summary. We debit the other revenue account, if there is another revenue account, credit income summary. When we're all done, like every other account, you add up the expenses, you add up both sides of the T account, take the big number from the little number, or take the little number from the big number, write the answer under the big number, and in this case we're told when they did all that, they had $388,000 in income summary. At the end of the period, the end of the year, you debit income summary, $388,000, credit retained earnings, $388,000. And that's the last journal entry where we close income summary to retained earnings.